Mary Giganti, right in the middle there, is an attorney. She specializes in ESOPs as well as qualified plans, so she has expertise in a crazy area of law called ERISA, which means every ridiculous idea since Adam. So she knows all the ins and outs and roundabouts about the things you've got to avoid when you're looking at things like ESOPs. Dave Gustafson, on your right there, is a principal with Apple Growth Partners. Dave is probably one of the leading ESOP specialists in the area of business appraisal in the area, and quite well known out of the area. How many ESOPs, Dave, have you done appraisals for, you think, in your career?
100, 150?
100 or 150. That's quite a lot. My name is Richard. We had Bill Rosenberg. The real reason why you're here is we actually have a real person who's done a real ESOP real recently. So Bill did his ESOP back in 2005,
Yep.
And he's going to share things like, well, why did he do this? How is this working out for him? He's going to talk about a little bit about what the process was, and what did he learn along the way, and would he have done anything different now that he's kind of gained some wisdom and experience? So we're going to ask him kind of at the beginning just to share a little bit about what he did and why, maybe 5 to 7 minutes. And the way we're going to try to do the panel, we've got a lot of slides, and we always have 15 pounds worth of stuff to try to fit into 5 pounds worth of time. So you're going to have to bear with us on that. But the real goal is to have an interactive panel where you can get the wisdom and experience of people who've done this kind of work for their careers. My role as the moderator is I get to tell people when to stop and when to start. I happen to be a business owner myself. I own a company called Ownership Advisors, and we advise primarily owners, entrepreneurial people, on how to make wise decisions about their most important asset, their business, and connect that to their purpose and values. So that's kind of what we do. So to get started, kind of the roadmap here, what I'd like to do is just kind of get a sense of who we've got in the room here. So the way I'd like to do that is ask for anyone who is here as an owner or representing an owner, so not the professional advisors, just to stand up. We won't embarrass you. If you could just stand up. You're here because you're thinking about an ESOP, possibly. Everybody that's here for that possible purpose. All right, so we got 4 people. Is that it? Come on, don't be embarrassed, don't be shy. Okay, so we've got 4 folks here. Our purpose today really is to talk to you folks. So we're really focusing on you. The rest of you, we do want to address whatever areas of interest you have with regards to ESOPs, but really our purpose is to help you get clarity. That's really what it is. And if you think about a stoplight, you've got a red light, a green light, and a yellow light. You're coming in here today thinking, well, I don't know much about ESOPs. You've probably heard a few negatives and positives. We want to, hopefully, in a couple hours, let you get out of here with, gee, is it still a green light? Is this still something that is a go? Should I be investigating it further? Do we have some caution lights? Do we know now that maybe this is not really what I thought it was? Or is it a red light? We've learned enough. And see if we can help you get to the red light quicker. That's a cost savings. One of the things that the panel has agreed to do, because we know that you can't get all your questions answered, especially when they're personal and they're to do with your business, in a couple hours. So what the panel has agreed to do is volunteer some of their time at the end. If you want to have a phone call where you could have the panel together, just for you, private consultation, no cost, no obligation, we'll arrange that. And that's a good deal, so I would encourage you to take advantage of it. I kind of added up the hourly rates, and I said, that's almost like $1,000 an hour deal. So they're willing to do that for a little bit of time, maybe an hour or two, to just help you get clarity so you don't waste time and energy on something that maybe isn't the right fit for you. So that's something I would take advantage of. Now, I have some props here. I have to put this on here. Okay, this is my crash helmet, and this is your gear bag. So you're going to have a day here in the ESOP Association that is very filled with information. So your crash helmet and this big duffel bag is going to be necessary. So what I would really encourage you to do is focus on not so much scribbling a lot of notes or gathering a lot of handouts, but just what can you gain regarding how ESOPs work, and more importantly, would they fit in your company, in your situation? So let me just jump into a couple introductory slides here. When we look at ESOPs, one of the tools that Mary's going to talk about, or one of the reasons, is ultimately, how do I get out of business? And so 7 C's of succession or principles would be, gaining clarity. If you know where you're going, okay, where you're going in the future, if you have clarity about that, if you have confidence that you can get there, if you can be focused or concentrated on what it will take to do that, because these things are complicated, whether you do an ESOP or not, right? You're dealing with a lot of moving parts, family, your stock, and all that. Consistency on how you do that. So if you have a clarity of where you want to go, you have to have some process of doing that. And then a commitment, ultimately, to stick to it. The character to guide you on that. And ultimately, I think, the capacity to have a good time doing it. So if it gets too unpleasant, right? Bob, is that fair enough to say that? You'll give up and you'll get tired and you won't want to do that. So, some of the key questions I'm going to put onto the panel as an end result is you should here's the questions I find people tend to think about. They don't always want to ask. Is can I really keep control of my company if I do an ESOP? Is that possible? Can my family stay involved? Can I get my family uninvolved? You might be thinking that way. Am I big enough to do an ESOP? I don't know if I'm standing in the way here. Probably am. How much is this all going to cost? You've probably heard that these are complicated, and there's a lot of different advisors involved, many of them in this room. Is it too expensive for the size and scope of my firm? And then how do I determine if it's a good fit for me? How do I go through some kind of feasibility assessment? So I'm going to stop right there and then kind of ask Bill Rosenberg if you could just tell the panel, tell the audience, kind of why did you do an ESOP, Bill?
Let me tell you real quickly a little bit about our company. My dad and a partner started Columbia Chemical in 1975. We manufacture chemicals for electroplating. Okay, not a real sexy industry, but pretty important industry. All the nuts and bolts and things on your cars are electroplated with zinc. All the stuff in the hardware store, the bodies of your computer before they paint them have zinc plate on them. So we're involved in the automotive industry, appliance industry, all that stuff. Okay. So my dad and a partner started in '75. Really humble beginnings. Couple of guys. One guy was the business guy. My dad was the scientist. And we're talking mixing drums, and pumping with a garden hose into 5-gallon pails. Company started to grow. I started in 1984. I think we were up to 5 employees then. Around 1989, my dad's partner retired. Still involved, taking profits from the company, but didn't work there anymore. About 10 years ago, 12 years ago, I started talking with my dad. My dad wanted to retire. Okay, how are we going to do this? So we really didn't have any succession plan involved. It was fly by the seat of the pants. We didn't know how much the company was worth. Everything was based on what my dad needed to retire. It wasn't a real business scientific approach. We made a lot of mistakes, a lot of stupid tax mistakes. Ended up costing me a lot of money. We finally got that straightened around pretty well. But what got me interested in the ESOP thing, I'm 44 now. 5 years ago, I started thinking, maybe retiring early might be a nice thing. I don't know what's going to happen. I got some young kids that are starting to get college age. They might be involved in this, but I didn't want to have the same no plan, installed that my father had. I wanted to have some kind of succession plan, some kind of flexible thing that could be a succession plan. And I looked at a couple different things, started learning about ESOPs. At that point, we had 30 employees. We were doing maybe $5 million in business. It was a good fit for our company. Is that about enough How much more do you? What was the
Yeah.
question again?
Well, why don't I think fast forward a little bit if you could. You went through a process of thinking about what you should do.
Mm-hmm.
Why did you ultimately land on ESOP?
Okay, why did we land on ESOP? Well, I had a couple major things in mind. I wanted to have some type of flexible succession plan where I could, if I wanted to sell the whole thing at some point, I could. If I wanted to retain control, I could. I had a couple other things. There were some really important people. I mean, I wasn't the only one that helped build this company. There were a couple relatives involved, a couple long-time employees. I wanted something that I could use without just writing checks and handing them out. Something I could use to reward these people for their efforts. Also, I wanted to instill kind of more of an employee ownership attitude in our staff. I wanted people thinking more like, hey, the profits, and we're doing this to make money, and we have a future. So when I heard about ESOP through one of these kind of sessions, I thought, okay, this sounds like a good thing. I could take a chunk of. Oh, the other thing is, I wanted to take a little chunk of money off the table. This had been working at this company for 15 years and working hard. Bought the company from my dad. My whole personal, basically, investment was in this, one stock of Columbia Chemical. And after I learned about the ESOP, that allowed me to do all those things. I was able to basically take $1 million out of this company and have a little bit wider portfolio for my future savings. I was able to reward the long-term employees they got stock basically as participants in the ESOP. And we're still working on the employee ownership ideas. I mean, that takes some years of communicating, but we're getting there. And also now I've got this flexible succession plan where I have now I know what my company's worth because we do these yearly valuations. And I've got this flexible thing where if I want to sell more to the ESOP, I can still control it. And basically, I've got a way out of this business, when I'm ready to do it.
Excellent. Just to add a couple of things, because Bill has been generous with his time, is also willing to share some of the financial details of his situation. So when the ESOP was set up, your appraised value was $3 million.
Right about that. Right about there, yeah.
So for those of you that are thinking, am I big enough? That's a pretty good starting point. If you're substantially under that number, you might have to really kind of sharpen your pencil to see if that will work. Now the appraised value is up to what, Bill?
I think we're working on getting our final appraisal. It's something over $4 million. We had about 35% growth.
Not bad.
For 3 years. Yeah. I mean, it's not like huge, crazy, explosive growth, but it's nice growth.
All right. Well, I think what I'd like to do is kind of turn over the next part of the presentation here to Mary. Everybody see that? Okay. There you go.
All right, so I'm going to talk about the legal aspects of this. What is an ESOP? First and foremost, it is an employee benefit plan. It's a qualified retirement plan. So when we start talking about ESOPs and all the great financing and transferring ownership, don't lose sight of the fact that it is a qualified retirement plan. As such, it is subject to the Internal Revenue Code and ERISA. So you're going to be governed by the Department of Labor and the IRS. So just like a retirement plan, like a profit-sharing plan, your ESOP is a retirement plan, but rather than investing in mutual funds, stock market, you're investing in your company. So the retirement plan itself holds the company's stock. When you do an ESOP, the participants don't actually hold the stock. It's the ESOP trust that holds the stock. Your ESOP has to invest in what's called qualifying employer securities. This is a defined term, and what that means is you can't say, well, I want to sell to an ESOP, I'll just give them non-voting stock. That's not qualifying, employer qualifying securities. You have to give the ESOP the stock that has the best voting and value rights of any other outstanding stock. So, for example, you won't see an ESOP that is just in preferred stock. It has to be voting common stock that has the highest dividend rights. And again, the employees are going to be the beneficial owners of the ESOP, meaning again that they're not the ones actually physically holding the stock. It's the trust that holds the stock.
Mary, can I ask, why is it important, what you just said, the issue of the ownership being the trust versus the employee?
Well, if we look at and we contrast beneficial versus direct ownership, if you think about direct ownership, if the employees held the stock directly, they would be shareholders having legal rights. They would be the legal holder of the stock as well as the beneficial holder of the stock. And as a legal holder of the stock, a stockholder under Ohio law has rights to financial statements and all the voting associated with that. In the ESOP, the trustee holds legal title to the stock. So it's the trustee which the company chooses, so you have control who the trustee is going to be. The trustee has those rights and exercises those rights for the benefit of the participants. They are a fiduciary for the participants. As a trustee, under trust law, you have a fiduciary responsibility to the beneficiaries. So the trustee's the only one that's going to have the information, your financial statements. They will vote the board of directors. For example, shareholders vote board of directors. It's the trustee that will do that, not the actual employees. There are some voting rights that we'll go into a little bit of detail later. We have a slide specifically on that. But there are certain voting rights that do have to be passed through to participants. And those would be super issues such as selling the business, for example, recapitalization, anything that would affect the actual ownership rights, value, you would have to pass through to participants. But again, that's why an ESOP works well for smaller businesses, because you can still keep your company private, the information semi-private. Some of the common uses of an ESOP. The ESOP is a tax-advantaged buyout vehicle for shareholders that are considering retirement or succession. Provides a market for other shareholders. We've seen a real explosion, particularly with the change many years ago. Only C corporations could have ESOPs. Law change, S corporations can have ESOPs. And with the S corporation ESOPs, we've seen an explosion where a lot of business owners, very young business owners, really use this more as an internal IPO, use it more as a financing vehicle, and continue on with the business.
If you have a shareholder that's not so friendly, I've had some clients put ESOPs in and get a friendly shareholder instead of an unfriendly shareholder.
Right. The ESOP also can provide stock-based incentive for employees. So as Bill said, that was one of his goals for the ESOP, and provides benefits and job security for employees. So it gives them certainty what's going to happen with the business, that the business isn't necessarily going to die with the owner.
Could I jump in and maybe ask Bill to comment? You are an S corporation, right?
We actually started as an S corporation, but there were some tax advantages for us to change to a C corp. So we decided to do that.
Okay. Well,
You can argue that both ways, but I felt in the end that was where I wanted to be. Mm-hmm. If we would ever become 100% ESOP, we would definitely go back to an S corp. Yeah. We would go back to an S corp if we ever became 100% ESOP owned.
Right.
And an LLC have an ESOP as well?
No, it has to be an S corporation.
Or a C.
Or a C, right. So you would have to convert the LLC to an S corp. Now your S corporation ESOP can own LLC interests. So if you wanted to, you could layer it on, but it has to be a corporation. Okay. What are some of the benefits to the selling shareholder? Liquidity, as Bill said. You know, most business owners, your business is your entire life. It's your entire investment. You put everything back into the business. And in order to diversify, to start getting some liquidity, the ESOP can help with that. The selling shareholders don't have to retire. They can continue in the business, run the business. They can maintain control. So just because you sell to an ESOP doesn't mean that you lose control. The transaction, as I said, is private. You're the one picking the trustee. You negotiate with that trustee. So again, it's private.
That's one, I guess I'd like to contrast that with selling to a third party, where if you have 10 people interested in buying your company and they all get all your financials and all your data and come in and kick the tires, you wind up opening your soul to the entire free world, versus an ESOP is basically a trustee you've chosen and you negotiating out what the transaction would be. That's a lot simpler and a lot, we don't always say simple with an ESOP, but compared to opening your soul to everybody coming in and kicking the tires, it is relatively private.
It is a stock sale, so you do have a tax advantage there. If you're selling the stock, you can have capital gains tax treatment, or the selling shareholder may defer the gain on the sale if it's a C corporation, which is probably why you switched.
That was one of the reasons why we switched. I ended up not actually doing that.
You didn't do it.
But that's a nice advantage.
All right. What are the benefits to the company? Well, again, this is a tax-advantaged vehicle to buy out the shareholders. Principal, interest, and dividends used to fund the buyout are tax deductible. So Uncle Sam is actually helping you fund your own buyout. If you contrast that with a conventional loan, your interest is tax deductible, but your principal payments are not. So with the ESOP, your principal payments, again, plus interest, plus any dividends used to pay off the loan are deductible.
Can I interrupt you for a second? That is a huge thing. When we're paying back this ESOP loan, the principal is deductible. You know, what loan you ever pay back in your life is the principal deductible? And we actually have a program where Mary mentioned dividends. You
pass them through?
Yeah, in order to promote this ownership feeling, when we have a good quarter, we pay some dividends. Those dividends are also
Pass through
as an expense, come off the taxes. So it's a lot of tax advantages. Sorry.
Right. No. Good.
Bill, one question I'd throw in there. Some people have said that the tax benefit the company gets ultimately can be used to strengthen the company. Have you found that at all?
Oh, yeah. We're able to use these tax savings to reinvest in projects.
You can be more competitive.
Instead of paying Uncle Sam, we've got more money to work with, basically.
Right.
So I thought they were going to have a clapping, I thought the owners out there were going to get up.
It took us a while to absorb this.
I'm glad you said what you said.
Well, you have to get into the nuts and bolts of it before you realize.
You do, but it's
See the
really
numbers.
significant.
You got to see the numbers.
It's really significant.
Right. As Bill said, with passing through the dividends, it does create a stock-based incentive plan, and passing through the dividends is almost immediate. I mean, they can see it with your first annual
It's nice to have
statement.
a little, it's great that you're building up this
Equity.
retirement thing. Everybody likes that. But, younger people in our company, they're never going to get old. You try to talk to them about a retirement benefit, they don't get it. But, if you're able to give them a dividend check, that's, cash in hand. That, to them, that's a real incentive to, be an owner.
Right. And again, with S corporations, your tax distributions can also be used to fund the loan. And again, the trustee holds titles to the shares, so again, it's kept private. Those critical, sensitive company issues are not passed through or disclosed to the employees, nor are they required. Okay. What are the benefits to the employees? Well, the employees can attain a beneficial ownership in the company, so then you can start that ownership culture that Bill talked about. It does take a while, and we'll talk just briefly later on about employee communications, but it does take a while to grab hold. You can also reduce uncertainty of ownership transition. So again, they're not worried if when the owner dies, that their jobs are gone, what's going to happen to the business. There's a plan. There's some certainty there. And then also a third benefit to the employees, again, because this is a tax-qualified retirement plan, the participants aren't taxed on their ownership of the shares until they take the money out of the plan. So you're getting a tax deduction for paying on the loan, but nobody's picking it up in income until they take it out of the retirement plan. And they can, when they quit, they can further defer that if they roll it over to an IRA. So just like a retirement plan, you can roll this over to an IRA. So again, the tax savings, the tax deferrals are enormous. How do you sell your shares to an ESOP? Before you actually make the determination, you want to have a feasibility study done. And I know Richard's going to talk about that a little bit later at the end on the next steps. But you want a feasibility study just to make sure that the company can support the ESOP, the financing, the cost of actually doing it. Once you decide, yes, we're going to go through with this, then obviously some due diligence will be done. Again, if you contrast it, as Dave said, to a third-party transaction, you're dealing with the trustee. So a trustee is going to come in, need to do some due diligence, but again, you as the business owner, you're choosing the trustee, so it can be kept relatively quiet. But they will come in, kick the tire, look things over, make sure everything's in order, because they are acting on behalf of the employees. I want to make sure they're making a good decision. Yes?
Who is the trustee? Can the trustee be the owner, or does the trustee have to be someone else?
The question is, who is the trustee? Can it be the owner or somebody else? In a perfect world, you want an independent transactional attorney, a fiduciary, to act as the trustee. And the reason being is, just think about what type of scrutiny and second guessing it would be if you're negotiating with yourself. So it's very hard to do. You can do it, but if you do it, you're under what's called a strict scrutiny standard, which means if the Department of Labor or IRS or even the participants come in and second guess you, you're held to such a high level that even if you acted with all the good faith, you were doing this really for all the right reasons, if there is one thing wrong, you lose. It's a very, very high standard. So you want an independent transactional trustee to come in and do it. They're not cheap, but it's an insurance policy because they're going to make sure that everything's done right. They will follow a process, and it'll save you a lot of heartburn.
Where do you get this fiduciary or trustee?
The question is, where do you get the fiduciary or trustee? There are firms, there are people that will act as independent. You can get referrals from folks here.
I was going to say, walk around the conference, and there are at least 5 of them in the building right now.
Right, get referrals, talk to them.
That's a professional business, actually, just being trustee.
It's usually part of either a bank trust department or that type of a situation. The other one we do see for trustees, if you're not going to have an independent trustee, generally get at least like a 3-person trust committee, and you may be one of those 3, but at least then you're not signing, you're not sitting on both sides of the table on the closing day, whether it's a key manager and a trusted advisor, and you as the 3 trustee committee, something like that, so you do have somebody other than you sitting on both sides of the table when you're closing on a transaction.
So did you use a trustee?
The question is, did I use an outside trustee? I have
the camera turned
I have
off?
so much faith in our high standards. No, we used our accounting manager, who's an employee of our company, to be a trustee.
Can you use an employee of the company to be trustee?
The question is, can you use an employee as a trustee? Yes, but you need to make sure that they understand what role they're taking on, because there's high liability with this.
What's their liability?
What's their
Well,
liability?
they're a fiduciary, so
Right.
they have to actually make sure that the decisions that they're making are in the best interest of the employee participants. So, things can't just be done with a wink and a nod. I mean, they're personally liable for the decisions that you that
Right.
they're making. In other words, like there's some really key decisions. Are they paying the appropriate amount of money for
That's the
stock?
biggest one.
That's the biggest one.
Right.
You know.
Right.
Now, yes, we've got one real quick thing. So I don't have an outside firm, and yes, if I was being most conservative, the advice they're giving you is right on target. However, we have other services. We have an outside administrative company that helps her, and we have an outside accounting firm that does a lot of work for her. So she has a lot of resources to help her make sure that she is following her fiduciary duties.
I think Leslie had a question or comment.
Well, I was just going to say that the trustees that practice actively in this area are members of all these associations. I'm sure John Little could tell you who they are, but the ESOP Association of Washington, the National Center for Evaluations in San Francisco actually post professional referrals, so the banks, the valuation firms, the trustees, all of those parties. So people that are actively involved in ESOP creation, have their names listed out there, and those are, that could be a good resource.
I gotta, before you ask your question, I make a comment. I'm going to put David on the spot. Of the 150 transactions you did, what percentage did self-trustee in your estimate?
Well,
Whether it's right or wrong, what percentage?
Oh, it's probably non-professional trustee is probably 2/3. It's a big number. Majority of these are done, and I won't say self-trustee. It's an employee. It's not the seller. Or a 3-person trust committee. Is probably the vast majority. 2/3 of the ones we do are individually trusteed or trustee a committee of 2 or 3 individuals.
For the actual transaction?
Oh yeah. It's becoming less and less, but it's still the vast majority.
So my experience is I think there's a point where if a company's on the smaller end, they're looking at ways to basically manage costs, and that's an area with due diligence you could. I'm not recommending one or the other. I'm just saying these are the realities. That's why these panels are helpful. But every transaction is different. If there's any complexity or issues where there could be conflict or concern surrounding value, absolutely you want to invest in the insurance policy that Mary's talking about. And that's so it's a facts and circumstances.
Right. Right.
John?
How important is it that this person be close to your company? I mean, to hire someone in San Francisco and you live in Ohio, does that matter?
No. You just want to find somebody that is competent and able to handle the process and the job that you're asking them to do. So you want to make sure that they have experience acting as a trustee in a transactional basis.
This is a paperwork thing. This isn't so much communicating to the employees or really knowing the nuts and bolts of what you do at your company, right? Is that be fair to say?
It's a process, right? Right. It is a process, and it's making sure that the process is documented. You want to, we're kind of jumping ahead a little bit, but you want to, on the valuation side, you want to make sure that you understand the valuation. You want to make sure that you understand the assumptions that were used, the methodology. There's checklists out there that the ESOP Association, people have put out sample checklists that you would want to go through when a fiduciary reviews a valuation report, making sure that you understand it, making sure that appropriate documentation has even been provided to the appraiser, making sure that the company's been forthright with all the information that was given.
So think of it this way. If Dave's firm did the appraisal and you had an employee, could be even the CFO of the company, they have to take that appraisal and they have to review it, and they're accountable for saying, I agree with the methodology, the process, and ultimately the value that's been created. Now, they are not the appraiser, but they're basically saying, in a sense, they approve that. So that's a liability that they take on. These professional firms allow you to pay for them to take that liability on. So you just have to decide how much of that liability you want to shift.
So the asked question would be, what's the average cost to engage an outside trustee to complete one of these transactions? And maybe express as a percentage of total transaction value, or, I mean, what's the trade-off? How much is a business owner potentially paying for trustee services here?
I am not a trustee, but they'll typically quote you in terms of basis points, 15 to 20 basis points.
That's the ongoing, that'll be the ongoing annual fee. A transaction fee is normally $50,000 to $100,000,
50 to 100,000?
15 to 20 basis points.
not for the transaction.
That's what.
I've had transaction fiduciaries on
Smaller deals?
smaller deals, a 30% deal
Or-
that'll do it for 20,000.
Okay.
What did it cost you, Bill, for the transaction?
Well, we didn't go for an outside
Trustee?
trustee, so.
But
it
your
was-
overall, I know you were
But
willing
but
to
the
share
yeah, sure, the
the
transaction.
overall fee
well,
when you add up the whole
certainly,
match.
certainly. Well, we did a feasibility study. We did kind of a pre-feasibility study, which entailed a lot of education and coming to these kind of things. We did a real feasibility study with quite a bit of due diligence, and I'm thinking that was somewhere around, probably in the end, $10,000 to $15,000, something like that. When we actually had our plan written by an outside administrative legal firm, that was probably around $30,000 to $35,000. And you have to have a yearly valuation of your company, which is between $5,000 and $10,000. Now, so to put this whole thing together to get our ESOP going, probably cost between $40,000 and $50,000. And on a yearly ongoing basis, we have an outside administrative legal firm help us. That's probably about
3 to 5.
yeah. I'm gonna yeah. Well, yeah. We do some things that other companies don't, so our legal fees are a little higher. We
Okay.
do some good things.
Dividends,
Yeah,
for example.
it's a little more complicated than the basic thing. So maybe that's $10,000, and I think our valuation is about $7,500. So it's probably there's some other costs. It's $20,000 every year, which we're very satisfied that we're getting.
Tax deductible, right?
Yeah, it's an expense of the company, so it's a good deal.
What percent does the employees own?
We're a 30% ESOP.
So just a caution, any figures he's throwing out have absolutely nothing to do with your company, because his company is a certain size and there's a
Yep.
certain structure and
Yep.
a certain level of complexity. So it's a benchmark that's probably on the low end of the benchmark,
Yep.
which is good.
Probably.
I think you did a good job of managing that, but your case might be very different. So
We were
I-
very careful with our costs.
yeah, that's good.
So don't be too shocked if if your costs come in a little higher than that. I think is that what you're getting at? Especially if it's a larger company.
Yeah, size does have a
Yep.
You
factor.
said you're very careful. How can you be careful? Just by the people you pick?
Well, we were careful, frugally careful, and yeah, we really interviewed and got to know a lot of people. We took a good amount of time before we chose these professionals to work with.
Can I also assume you did a little bit of homework on your own first, so that you didn't know nothing and were starting from ground zero when you hired the professional, and they had to do
Absolutely.
everything for you? A knowledgeable client can go a long way towards speeding the
Right.
process for those of us working with them.
Right.
Right.
We pretty much knew the structure that we wanted, and we knew
Okay.
the questions to ask and that kind of thing.
That helps. It really does.
Right.
All right, I'm gonna be the moderator and ask us to get on our task. I know that this is all important stuff that we all want to hear, but let's try to keep our
All right.
task. Otherwise, the OEOC will claim we didn't do our job.
All right. Well, then I'll.
What does a typical ESOP transaction look like? And actually, I have a couple slides. One is typical leverage ESOP, and the other will be a non-leveraged ESOP. And see how this works. But with a leverage transaction, obviously you have a shareholder with stock that would prefer to have cash, and an ESOP that would prefer to have stock but has no money. And therefore, we have to go looking for funding sources. And obviously, the ESOP could go to a bank, but ESOP has zero collateral other than maybe the stock they're buying. And I don't know if there are any bankers in the room, but do you lend to anyone with private company stock as collateral exclusively? And the answer is almost always no. And therefore, how do we get something that the bank would lend to? Well, you bring the company in, get the company involved. And in this case, you wind up doing, I'll say, a series of 2 loans, i.e., if you want to do $1 million transaction, the bank will lend the cash to the company for $1 million, take a note for it, and then basically the company will do a separate but nearly identical transaction where it will loan the ESOP money, and the ESOP will give the company a note as well. And those are separate notes, and it'll come into play later because the company, if it winds up with some extra cash, can just pay the bank off at some time, and transactions between these 2 parties don't have to be identical to what goes on with the bank. But anyway, money goes from bank to company for note, company to ESOP for a separate note, and then the ESOP has cash and it can go out and buy the stock from the shareholder. You can also, if you're doing a smaller deal, and by the way, is that pretty much how you,
$1 million deal.
basically that transaction structure?
Exactly how we did it.
I was hoping I got it exactly right for you. We are seeing some S corps that the reason sometimes people do leverage deals, A, they want to get to a certain threshold quickly, but also with the C corp and the 1042, you have to get to 30% to do 1042. So we were used to having people want to do as much as that and to do a leverage transaction to get to 30% ESOP. With S corps, we've had a few more that have just said, I just like to stick my toe in the water. Can I do a 5 or a 10% ESOP? And the answer is yes. And then you don't necessarily even have to borrow the money. In that case, you can have the company literally just make a contribution of cash at the end of the year to form an ESOP, drop some cash down in the form of a deductible contribution, and then if the ESOP has $100,000 or $200,000 of cash, it can just go out and buy stock from the shareholder, and you don't necessarily have to have a bank. And in fact, you can get to 100% just doing this every year for 5 or 10 years, as long as you have enough contribution to make every year. You just start buying the shareholders out a little slower. We have seen a few more of those done more recently. Okay. Oh, let's go ahead. Okay. Now, back to my leverage transaction where how does the bank get paid off and how does the company get paid off? You've got your transaction for $1 million in place, and then at the end of year 1, what happens to start paying the loans off, and they are separate loans. The company will make its tax-deductible contribution to the ESOP. Put a number on there. How much did you make the first year? A couple $100,000?
I think the first year was about $80,000.
Okay. So you'll make a contribution to the ESOP, and that, by the way, is what makes it tax-deductible. It's a pension plan contribution. And then ESOP basically just turns around and gives the money back to pay off its loan to the company.
Now, you know what? It was a couple $100,000.
Okay.
Yeah. First couple of years, it was a couple $100,000.
That's what gets you the deduction. That's the cool part.
That's right.
So that, and you also allocate the stock based on this part of the loan. Obviously, then, if the money's gone down, come back up, got you a tax deduction. The company then has the money. It can also pay the bank off. By the way, I have had companies that do a little more of this. If they're growing and need the money, they've paid the loan, they've done the transaction contribution to the ESOP and paid the company loan off before they've paid the whole bank loan off. Those don't have to be identical. This gets you the tax deduction, and that makes the bank happy.
Actually, we did that. Ours is very accelerated. That inner loan between the company and the ESOP, that's just about paid off. We still probably have 3 years to pay. That's going to take us to pay off the bank loan.
And if you need working capital to grow a business as much as it has over the last few years, you can, as I said, the point I really wanted to make sure everybody understood is these are separate loans, and they can be dealt with separately. You don't have to pay them off identically. Here's your tax deduction part of it, and then whatever you negotiate with the bank is between the company and the bank. So, okay, a few technical X's and O's. If you have an ESOP, you have to have a stock valuation at least once annually. Basically, it's for statement purposes, if nothing else. You have to have something to put on a statement for everyone, and the government requires an annual valuation. You may also get another valuation during a year if you do a transaction. The day you do your transaction, you'll actually have something in the file that says, as of this date, the ESOP is not paying too much for the stock. So you may have more than one valuation on your deal year. Otherwise, it's a once-a-year event. The appraisal firm works for the ESOP, not for the company. So my engagement letter will always say, Dear ESOP Trustee or ESOP Exploratory Committee. It will not say, John President. of the company, we're supposed to work exclusively for the ESOP. And then obviously some of the DOL regs require that the appraisal be done by someone qualified to perform an appraisal. An independent expert is the big part of that. Try and do this quickly, Stein, and I promised Richard I would not put one number in here at all to do on evaluation presentation. So, and I will stick to my word there. What you're looking at for an ESOP is fair market value. Yes, that's the willing buyer, willing seller test. In a nutshell, it is what would you expect to sell the stock for in a market transaction. What's critical here, though, is maybe what you're selling, i.e., a 30% interest in your company might not be worth the same per share as a 100% interest in your company. And therefore, the appraiser does have to take that into consideration in fair market value. The ESOP does have, the participants do have a put option sometime after they leave the company to get cashed out. So generally you don't have marketability discounts as bad as if it were a 10% interest in a private company with no ESOP. But generally you're going to have some differential in value if you have a 10% ESOP versus a 65% ESOP or 100% ESOP. The second rule has evolved. The DOL doesn't want to be outdone, so they had their own definition of value come up, and that's called adequate consideration. Basically what it is a two-part test. Adequate consideration is fair market value determined in good faith by the trustee. And believe it or not, even if you get the number right, the DOL likes to whine if you didn't do good faith determination. They want the due diligence on the trustee's part. The trustee can show them a nice thick file that said, we looked at all this, we understood it, we read it. I work real hard to get my ESOP trustees to go ahead. I'll send them a draft valuation, and I tell them, go ahead and mark it up like crazy. Put a bunch of questions in it, but by the way, also put answers when I give you answers to it, so that you have a nice little record to show the Department of Labor. Here's the valuation. We asked questions. We got answers. We understand it. Go away. And the documentation is really what helps the DOL go away. There are times I think they almost don't worry about getting the number right as much as showing the process. A couple things I mentioned before, that you report to the trustee and that you do need to be independent in an appraisal. Okay, how do we determine value in a stock? Well, I asked some friends, and these were the answers I got, how I do my work. More realistically, there are three ways to approach valuing a company. You can get a market approach, an income approach, and an asset approach. Market approach, if you will, is the easiest analogy to make for a market approach is how people appraise your house. If you have a house and get it appraised, they're going to go out and find 10 houses in your neighborhood with the same number of square feet roughly on the same size acreage lot. And if that number is $250,000 to $300,000, your house is probably going to appraise somewhere between $250,000 and $300,000. They make some adjustments. If you have nicer amenities in your house, they may, if it's on a lousy lot instead of a good lot, you may get a lower number, but it's generally going to fit in that range. With a business, it's a little bit harder to find comparables, if you will. But it's basically the same analogy we're trying to make. We're going to go out and find companies that are in the same industry as you so we can find out what an appropriate multiple is. Whether we use public companies to do that or private transactions, we're going to try and go out and see what the market, if you will, thinks of your company, your industry, or companies with your characteristics.
We have a question over here, Dave.
Dave just answered it. I was going to ask if you can use private company transactions to appraise per IRS rules.
You certainly can. Each of it has, public company analysis has a challenge of, I compare a $25 million private company to a $1 billion public company. Obviously, there's some size issues there, needless to say. In contrast with that, with my private transactions, sometimes it's just hard enough to find enough transactions in the niche business you might be in or something that looks like it. And then even when you get that, I don't really always know what the broker reported. Did they, one, if there was a contingent payment, did they include the full amount of what it might be sold at, or did they include the minimum of what it absolutely would get? Did they include the covenant not to compete in the purchase price? Did they include a deferred comp? So you're never quite sure what data you got. And if you got a sample of 3 and you don't know what the data you got is like, you're not always comfortable with that kind of a sample. But you're doing the best you can to try and find what the market thinks of a given industry and company. When you have a sense of what the market thinks, then you can look at, do you use multiples of EBITDA, EBIT, earnings, cash flow? Actually, in the accounting world, I think there's almost a price to revenue multiple is a pretty good benchmark I've heard over the years. But you'll look for in your industry what's the most commonly used. And I guess I'm most used to EBITDA at this point because although if a company's not real capital intensive, EBIT I tend to think provides as good an indicator. I'm sorry, EBIT is earnings before interest and taxes, and EBITDA is earnings before interest, taxes, depreciation, and amortization. And the reason those have become more the benchmark of what people look at to value a company, someone that comes in to buy your company doesn't really care how much interest you pay or what your tax structure is. They're going to have their own capital and their own financing and their own tax structure. So they're going to look at your company before interest and before taxes for sure. And they may look at how much CapEx or how much of that type of thing they want to put in, so they may want to look at it before interest, taxes, depreciation, and amortization to sort of look at what kind of cash you're generating, and they're going to figure out what taxes and what interest and what CapEx they need to do to offset it. So they'll generally look at, certainly in non-ESOP transactions, I think you'll get more looked at in that regard. But that's why, it's because they're going to figure out how they want to fund it themselves. Okay, second method is an income method. Most of the time we're talking here about a discounted cash flow. And what we look at there realistically is try to project your results out into the future. What are you going to earn for the next few years as a company? And I know, it's one of those, if I had that good a crystal ball, maybe I'd be working somewhere else making a lot more money. But the goal here is look at what you're doing in your business, what your industry is doing. Is your industry growing 10% a year? Is your industry shrinking? And how are you outperforming your industry? And when you look at a company and analyze it deeply enough, you can at least make some reasonable assumptions as to you should be growing, you should be shrinking. What's a little harder, I guess, where the economy's at right now, I have a number of clients that are saying, nobody wants to admit it too well, but I have a number of clients that aren't betting 09 is going to be as good as 08 or 07 are at this point. So you do try and just sort of put your crystal ball out and say, what are we going to look like for the next few years, and what kind of cash are we going to be able to generate? And then in its simplest terms, bring that back at a discount rate to present value. If a company grows or is very stable, you can mathematically do that based on the current year earnings by capitalizing the current year's earnings. But capitalization of earnings is generally just a very simplistic mathematical model for a discounted cash flow. And when we talk about cash flow, generally we will look at the kind of cash a business generates. And that's one we've had some fun getting employees to understand, because everybody thinks about reporting profits as sort of the best thing. But if the money's going into receivables and inventory and other sources and you're not generating any cash, do you have money to pay the bank off? Do you have money to pay dividends? Have you had any fun getting your employees to start to understand the difference between A, profit, and B, cash flow?
Oh, yeah. And then you've got the repurchase obligation mixed up in there also.
Fair enough. If they want a nice big number at repurchase, they better make some first. So we do look more at cash flow, if you will, than profit when you're looking at a discounted cash flow model. And then there's the cynic in me. I have a couple of CFOs that have actually both sent me this that are a little cynical about what we do. I don't know if you have any Dilbert.
Is that when you need the crash helmet there, Dan?
I wasn't unhappy you had it, But yes, there's sometimes people do sort of look at it as the devil's in the assumptions, and what do you call assumptions?
Aren't about 82% of statistics made up on the spot?
82.5. I'm going to maybe interject here and ask the panel and ask Bill to also comment on. At the end of the day, this is you can see it's fairly complicated to develop a value. What would you, as panelists, say? And Bill, you can certainly chime in. Do ESOPs actually deliver a fair value when you account for some of the benefits you get from a tax perspective, or is it really just a giveaway? Okay, is it not a good deal for you as a seller? Are you the benevolent guy that's selling and you're really taking a discount to your value. That's one of the objections people, have to wrestle through am I getting a fair value by selling to my ESOP or not? And so, Bill, what was your opinion? You did an ESOP. Was it a fair value?
Well, we always think our stuff is worth more than maybe it is, right? It's not so easy to answer that. I think you'd like me to jump up and say, yes, it was a fair value.
That's why you're here?
I think it was pretty fair. I think it was a pretty believable value. Do I think that I could have gotten more with more strategic of a sale? And a strategic sale, I'm talking about, going out there and
Finding someone that would run your company considerably different than you would.
That's right. Yeah, I have a fantasy that yes, if I didn't care about the future of this company, I feel that I may have been able to look for a strategic buyer who was willing to pay more for this thing. But at the end of the day, when we get our annual valuation, I'm comfortable with it. It's believable.
And it would have been a trade-off, right? If you went to outside buyer, you wouldn't be here on.
You know how
panel.
long those deals take to put.
Florida.
So
you'd have to
look for a
sold
strategic
at 100%.
buyer. I mean, yeah, right. And I wouldn't have had all these other advantages and the flexible, thing that the ESOP gives us for future, succession planning. And those strategic deals, they can kill you. They take a long time to put together sometimes, and you got to show a lot of people all of your finances and everything. So yeah, I feel that I'm pretty comfortable with the valuation.
And I think what Bill is saying holds true, that if you're just out there looking for the highest value, you're not going to do an ESOP. It's all these other extras that come with the ESOP. It's the commitment to the employees. It's staying in the business. It's wanting to diversify your own personal portfolio. So I think if you're looking, you have to look at the reasons. Why are you looking at an ESOP? Are you looking just to sell your company? Well, maybe the ESOP isn't the right answer then, because it is a trade. There are some trade-offs there. But if you're in a situation similar to what Bill's is, then the ESOP works very well.
Yeah. If you just want out and the most money you can get,
and you don't care who you work for tomorrow,
the ESOP may not be the best answer for it. It still might be. In some cases, it actually is. But
I guess from a financial standpoint, I hope that the number I'm putting on the table as an appraiser is close to what a financial buyer would pay for you. If there's a strategic buyer out there that wants to pay more money than God, go ahead, wonderful, good for you. But I'm hopefully, if there are people out there that just that are looking at this as an investment, I'm hoping my number's pretty close to that. And I've actually had a couple of people go out and get expressions of interest over the last 24 months, and both times I was within. One time I was right on the money, right in the middle of the range of the 5 expressions of interest, and the other time we were within about 5%. So it was closer. But what the difference really winds up being is, if you're sold 100% to a third party, that happens now. An ESOP, you're generally going to do this over a period of time, and because you probably don't want to leverage your company up 100%, even if you could. And very few of our sellers want to do that. And if you want to do this, and if you still have a lot to contribute to the company, or if you don't want the last 1, 2, 3, 5, 10 years of your career to be working for somebody else, and God knows who that is, the ESOP certainly gives you the ability to control your destiny while you're selling. So hopefully I get you close on dollars or the same, and it's a little bit about where you want to go and what you want to do while you're doing this. That's the honest from my perspective.
Mm-hmm. We have a question over here.
Dave, when you deliver a valuation, are you delivering a point valuation or are you delivering a range?
Generally, we deliver a point because you have to write a check for a point, and you have to cash people out every year at a point.
Right.
Is that a little bit arbitrary? Yes.
That's my next question. Is there typically negotiation between you and the trustee concerning the valuation that you've rendered? Not
to some degrees, more or less.
Expert. I know that you
No.
are.
No, actually, that's fine. In some some deals, the buyer and seller get together and say, we think this is a reasonable number, and then they go out and we get an appraisal, and if I can support the number, we agree to it. In some cases, it is a little bit more negotiated, where buyer thinks here, and we go back and forth and see what we can do to come close to that. But more times than not, they'll either, I've had clients say, go get the appraisal, and if I like the number, I'll agree to it. And I've had some put a number on the table and ask, can you support this number? And I've had some that you wind up with a little bit of negotiation in the process. And if you know there's some negotiation, obviously the work I'm going to do is the range could be 3.5 to 3 3/4, not 3.625 million as a number. You need that because you need to write a check for a number on a deal day, and/or people don't like 3.5 to 4 million on their statement every year. They sort of want a number on it. So I have to do the rather arbitrary one number for statements.
I'm going to ask that we, just for time purposes, Mary's got a few slides, if we could hold your question maybe on value. Valuation is complex. It's why you need the experts. Let's kind of move. You got another slide there yet?
One more, and the only reason I'll say, we'd also do look possibly at net asset value,
I'm
i.e. assets minus liabilities at fair market value. I will put this, for a capital-intensive company, it's probably relevant. But if you're thinking about doing a deal, I'm more interested in one of the other two methods, because you can't really spend net asset value, if you will. You can't cash a business out. You can't, if you don't have the earnings value to support it, and people can't take their annual distributions out of assets, they need to take it out of earnings, discounted cash flow. And let's turn it back to Mary.
All right. 1042 transaction. This is when the seller of a C corporation sells the stock to the ESOP and there's no taxable gain on the sale. If you elect 1042 treatment, the tax is deferred. So if you're a C corporation, you want to sell $1 million of stock to the ESOP, get the $1 million, no tax. Rules in order to have that privilege of no tax is the ESOP must own at least 30% of the company. With your $1 million, you must reinvest in what's called qualified replacement property within a 15-month period. Qualified replacement property is U.S. domestic stocks. So you cannot go out and invest in mutual funds. That doesn't qualify. It has to be actual investment in an active company. If you have your own private personal real estate company, that's not an active business. That's a passive business. So you have to invest in a U.S. Active business. Bonds don't qualify either.
Municipal bonds, corporate bonds do.
Right, municipal bonds, right. Right, treasuries, right. 1042 must be elected in writing, so just doing all this isn't enough. On your tax return, you must make the election. If you don't make the election on your tax return, then you basically kind of blow this election. So it's important when you have all your advisors together that everybody understands what you're doing, so that your accountant knows that you did this, that you wanted 1042, so when they file your tax return, they make the election. If you take 1042 treatment, then you cannot participate in the ESOP. This would include your family members and certain more than 25% shareholders as well.
Can I jump in there and maybe just comment on that? More and more people are considering that maybe the taxes are as low as they're going to be right now with capital gains. So some folks are rethinking the benefit of this deferral, and so what's really important when you're involved in this kind of thing is integrating your estate planning goals long term with your ESOP strategy. So for example, Bill shared with us that he went through this whole thing back and forth and ultimately elected not to take the tax benefit of the 1042, which is just an election you take. One of the reasons, or maybe one of the unintended consequences, was he found out that it was a good idea, being a younger owner, for him to participate in the ESOP. So he's in the trenches with his people, so he's able to get allocations of stock. Was that one of the reasons why you picked it?
I'm one of the big participants in the ESOP. So in a way, it's double dipping. I'm sold our stock to the ESOP, and now I'm also a participant. Also, we've got some family members working, and when the reality hit that they weren't going to be able to participate in the ESOP, that was pretty much of a bummer. And then the third,
There was some motivation there.
the third idea was, that's right. And the third idea was when it came to replacing that stock with qualified stock, you've got to make your selections. And I sat with a few advisors and brokers, and basically you've got to let that stock ride. You can't just you can't buy, sell qualified stocks from companies. That has to remain pretty stagnant.
It's a deferral so that when you
Right.
sell the replacement property, you trip the gain then. So
Right.
if you sell the property 6 months later, you only deferred it 6 months. If you hold it 15 years, you've deferred it 15
Right.
years.
I decided just to take the tax hit right then. And the other nice thing was, because I did that, we built a new building this year, actually. So I needed that. I ended up using that money for a big chunk of the down payment on our new building.
Just a point of reference, I think with a smaller transaction, not that $1 million is small, but it's small relative to the ESOP world, doing what Bill did makes a lot of sense, especially since he's probably thinking 20, 30 years from now he's going to be in a higher bracket possibly. However, when you have larger amounts, there is a technique. We won't go into the details of it, but you can put money into a vehicle, okay, where you can have a fixed yield investment like a bond, 50-year bond, and you can borrow against that vehicle and then use the borrowing, the borrowed money, to invest in an actively managed investment. So what he's saying is true. If you don't want to do that because it's too complicated, you would have to basically pick all the right stocks and bonds all at once and kind of hope that you made the right choice there. And every time you have to sell one, you incur a tax, versus a strategy where you can leverage, okay, off of a borrowing strategy.
That's why you make the big bucks.
Well, I don't
Because
know about that.
you can figure the complication out.
Yeah. Anyhow, so that would generally be a strategy that, again, you want to coordinate when you're doing this planning. It can be part of feasibility. There's a team of people you have to really got to think about. You've got your business side of the equation, and then you've got the personal side. And these taxes that you're saving or deferring really have to tie into your overall strategy long term. There's more than that than we can cover in a session like this. I think you're going to touch on that with some of the slides you have near the end, I think.
All right. And then what Bill was talking about was non-1042, which you sell your stock, it's a capital gain treatment, and then you can participate in the ESOP. So as he said, you're actually selling your company twice, once to the ESOP and then as a participant, when you leave your participation, you're selling there as well. Okay. What are some of the options? Well, you can do a partial or 100% sale. Obviously, that's going to be driven by the economics or even your desire just to kind of ease into the ESOP. If you sell at least 51%, you're going to have no discount for the control issue. And if you're doing a partial ESOP in with all your planning, some things you want to consider would be, are you doing a staged transaction? Are you going to sell 30% now and then 30%? And how are you going to do that? It may influence the design, the duration of your financing, for example. Leverage simply mean, are you going to borrow in order to finance this? Either the ESOP or the company can borrow from the bank. Again, the contributions to the ESOP are tax deductible. If it's non-leveraged, that means you're just purchasing outright, and I think Dave's diagram showed that well. The other way that you can do it is not necessarily purchasing the stock from the shareholder, but if there's additional treasury stock within the corporation, you can actually give treasury stock to the ESOP. So on paper, you're giving stock and you're creating a deduction without the cash really being there. So there's another way to get shares to the ESOP. What are some financing alternatives if you want to finance this? Obviously, bank lending, mezzanine, outside equity, senior equity. Seller can finance. If you already have, banks are getting a little tight, you can consider seller financing. That's entirely appropriate for the seller to finance. If you have another qualified retirement plan, 401k, profit sharing, you can use part of that money in order to start the ESOP and to use that. I would caution, however, that if you're going to do that, it's obviously a securities, because you're selling securities, it's a security transaction, so there's going to need to be a lot of disclosure to the participants. They will need to elect, particularly in this environment where we are with a lot of company stock being held by retirement plans, they'll need to elect if they want to use their money to purchase stock. So that is an opportunity. However, you want to make sure that it's done right, and you caution the participants with that. Understanding company philosophy. In setting up the ESOP, you want to think about how are the employees going to view this? How am I going to communicate this to the employees? Are they going to view it positively? Well, a lot of that's going to depend upon you and how you go about this whole process. Are you going to involve them? Is this going to be an open process, or are you going to keep this under a veil of secrecy? Because obviously if you're very secretive about this, there's going to be a lot of suspicion. Well, why is he doing this? It's got to be only good for him, no good for us. So again, it's very important that you communicate this properly. Once you actually decide to do the ESOP, you want to have an initial meeting with the employees to introduce this, and then have annual meetings where you hand out the benefit statements.
I was going to say, how much did you tell people, and when did you tell people about
Oh
all
my gosh,
this?
we have a lot of communications.
Did you tell them before the deal was getting ready to be inked?
I
or
did.
When did you decide?
I told them way ahead of time, like a year before we actually did the ESOP, because Mary's very right there. Boy, if you don't tell the employees, they think that this is going to be bad for us. They're very paranoid about everything.
It's a challenge because many of our owners, they don't want to commit that they're doing this till they figured out, yes, we are absolutely doing this. So there's a little bit of I don't want to promise my employees something because I might not be able to deliver on that promise. Right. And then all of a sudden you get pretty close to deal day and there's still not a lot of knowledge out there. So it's balancing what you described of the comfort of the employees where I don't want to promise them something I might not be able to deliver.
Because I knew I was going to be involved with this company for a number of years, I took the route of a lot of disclosure.
Okay.
Right. And there's a lot of companies here that do, they have, ESOP communication days, they have ESOP picnics. I mean, there's a lot of things you can do to help build the whole ESOP idea.
Yeah,
so
ESOP
I would
communication committee.
Right, you have ESOP communication committee, right. So I would encourage you to talk to companies around here today and ask them what they do and how they involve their employees. And again, you can have the employees participate in the ESOP either on the administration committee, as the trustee committee, or on a communication committee. So those are different ways to get them involved.
Mary, I have the unenviable position of giving us the 10-minute warning.
All right.
So here's what I'm going to just suggest. I think the next slide that Mary has up, I'm going to sort of take executive privilege. I think we saw the diagram that Dave put up, kind of diagramming the flow of money. So I'm going to suggest maybe we can jump over that.
Yep.
The next slide that Mary has really gets into ESOP plan design. That could be, a half an hour, 45-minute conversation. The most important thing I would think is that there's so many different factors that involve determining how, and you think about when you set up a 401k plan, if you've done that, all the different things you have to think about in terms of eligibility and allocation. There's a lot of similarities to a 401k plan, but then there's a lot of things that are different. Mm-hmm. So I think
a simple suggestion, as you get ready, if you decide to go forward, keep this list handy and plan on spending some time either with counsel or your advisors on how do we want to do each one of these. Tell me the pros and cons, because there are different, how you make distributions is there are pros and cons to doing it various ways. But sort of keep this as a list of, yes, we need to talk about all these things, because these are the X's and O's of how the plan works.
Are we going to get a copy of this list?
There was a set of handouts in the back, and if you give me your card, I'll happily send it to you. If there's none of them left in the back of the room,
Just that.
Okay.
The next slide I'm going to just jump us to would be voting And I think what would be the most important thing about voting, Mary, that you, if you could leave that with our 3 or 4 or 5 owners out there, what would be your...
Well, again, the voting rights with the closely held company, there you go. With the closely held company, the trustee votes the shares for most corporate matters. Again, it's very critical matters such as mergers, recapitalizations, liquidation, sale of the company that you would have to pass through to the participants. And again, that is a whole process that you would need to go through as well.
But the day-to-day stuff is all done by the trustee.
Trustee. Right.
Okay, so
Okay.
next slide, maintaining a management team. Why is that important, Bill, to have a good management team when you do an ESOP?
What are you talking about, the management team? The team that's managing the whole ESOP conversion, or the management team?
Maybe
of the
that's not a good
company?
question for Bill. When you set up an ESOP, was there conversation about what you need to have to maintain your company and run it, as opposed to the ownership, which is an ESOP? ESOP is an ownership transition vehicle, right? It's not a management transition vehicle. So you understand what I'm saying?
I'll answer a question.
Well, I've really blown this one.
No, I actually don't understand what you're saying. I still don't understand. Are we talking about the management team of the company or the management
The
team of the
company in
process
general.
of the ESOP?
The company.
See, I mean,
Okay.
you don't have quite the issue. Most of the folks that when we do this are doing this as part of a succession
Okay,
plan.
I think I understand. Let me say this. 5 years ago, we would not have been ready to do this. We did not have a strong enough management team. We were not doing enough strategic planning. We did not have strong enough middle managers. We were still running it like a mom and pop. I would say it's important to be able to do all those things and strengthen your management, strengthen your company, have a strategic plan, have everybody on board with how the company operates in order to really be successful with the ESOP. Is that what you're getting at?
Absolutely.
Okay.
I think the next slide I'm going to ask Mary to jump on is the repurchase liability. And I'm just going to make a quick comment on that without going into detail. When ESOP shares are moved to your employees, there's a trade-off. You get a good deal up front. Eventually, the promise was that you're going to buy the shares back. So at some point in time during the process of looking at an ESOP, you want to plan for or have a strategy for how you're going to buy the stock back. And that makes sense that if you're going to promise something to your employees and communicate it and get them excited about it, you want to have a strategy for that. And so that's called the repurchase obligation or liability. Dave talked about it in terms of what's called a put right. There's a legal right that the employee has to put the stock back to the company, and that right then needs to be maintained or managed, and the company oftentimes needs to have a plan or a strategy on how they're going to do that. The next slide there, Mary, if you could click impact on other retirement plans. I think it was referred to that you could have another retirement plan. What do most companies do, Mary, when they have a 401k plan and they're thinking about an ESOP?
Right. Well, when they put the ESOP in place, what they typically do is they replace their non-elective profit-sharing contribution that they were giving to the employees with the ESOP contribution.
Mm-hmm.
They'll still continue the 401k elective deferrals that the employees put in. Most of them will continue the match or some level of match. But again, that company non-elective profit-sharing contribution will typically go away and the ESOP will replace it.
So the idea is you don't want to present an ESOP as something that's taking away a benefit
Right.
necessarily. It could be perceived as negative rather than the positive that it really is.
Did you say you would replace the company contribution to the 401k with the ESOP?
Right. If you look at when you're looking at your feasibility, for example, and you're saying, okay, in order to have the ESOP, we need to put $100,000. We're going to need to put in $100,000 into the ESOP every year to finance this. And you're saying, well, where do we get the money? Well, in our 401k profit sharing plan, taking aside the match, the company's been putting in $80,000 anyhow. well, let's just take that 80,000. Now all we got to do is come up with 20 to really fund this. So
You're
they'll
still making the
replace.
match.
We're still making the match.
The 80,000 was above and beyond.
Above and beyond, right, the additional company, right, because a lot of companies will do like if they're like what's called a cross-tested plan in order to get the owners the maximum that they can in a profit-sharing contribution, they have to give the employees 5% of pay. So most small businesses that are aggressive with their profit-sharing plans will do a 5% of pay anyhow. So it's just a matter of replacing that with the ESOP now.
All right, we'll skip the estate planning slide and kind of jump on, because we got a 3
Yeah.
minutes. And I think we talked about throughout this this conversation, you've heard the words feasibility study come up several times, and you'll hear different definitions of what that is depending on who you talk to. But here's a written definition. From an outcome standpoint, the goal of a feasibility study is to really determine as quickly as possible and as inexpensively as possible, is an ESOP right for you, your family, and your business? So there's all different ways of doing that. One of the aspects is, from a cash flow standpoint, is an ESOP financially feasible? And so there's two basic aspects of feasibility, in my view. There's the financial aspects, which we'll explore for a moment, and then there's the non-financial. So when you look at the financial aspects, those things deal with the company value. Is your company big enough? Is it growing? What's the future look like? Is the company financeable? Can you borrow money? What's the cash flow, and what would be the impact of borrowing money on the company? And really, what you're measuring here on the left-hand side is really, I'm going to jump through it, is can you do an ESOP? Is the financial capability there to do the ESOP? And what's interesting is that in most cases, if you have a successful company that has profit, and you're over a certain size, let's say $3 million of value or greater, it's likely, if you got the right team of advisors, that you can figure out a way to make an ESOP work. Would you agree with that, Dave and Mary? So the question of can you do an ESOP is somewhat black and white. Where I find that there's oftentimes not enough focus is should you do an ESOP? Okay, and that gets into things that are less black and white. The values of the owner. What does the owner really want to do? Things like how much money do you need and how much do you want? The question of getting a fair value, or something else. And dealing with your family members and kids or family members that are in the company versus ones that aren't. Does the ESOP provide a vehicle for doing some of those things? And ultimately retaining control and balance. So the question on the right-hand side is really more should you do an ESOP? Okay. The questions on the left-hand side are can you do an ESOP? So a good feasibility study really needs to kind of look at both sides of that equation. So we have run out of time. However, we could stay a few minutes if you'd like. Again, what I had suggested is that for any of you that would like to have a follow-up phone call, confidential, with the panel, give me your card, just write on the word feasibility. If you can't spell feasibility, which I can't, F-E-A-S, period, you can figure that out. We'll arrange a phone call. It'll just be a short kind of thing where you can ask the questions that maybe you didn't want to ask in the group setting. And first of all, I'd like you to give a hand to our panel. They did a tremendous job. Particularly Bill for being willing to, share a little bit of his financial house with us. And then I think if anybody, lunchtime is served right now, so if anybody has a desire to stay back and ask any of the panelists or myself a question, you certainly can do that, but we're keeping you for lunch at this point in time. So again, if you're interested in that follow-up, give me your card. I'll arrange that call for you. So thank you very much for coming.